Almost.
That close, Jason. You know,
It didn't click the first time.
I almost hope people come late. Or maybe they come early just to see how we're going to mess that up. It's impressive. We're good at it. Ladies and gentlemen, this is the Pirates of Finance. We are your co-hosts for this adventure we're about to take you on all things finance, economics, particularly macroeconomics, business, entrepreneurship, everything under the sun. The man to my right, left, I actually don't know what screen direction you're on, is the young Hemingway, Jason Buck, on the road today. I'm a little disappointed. He owns like maybe 5 shirts to his name and claims he can travel with everything in his wardrobe whenever he travels, and yet somehow didn't bring the Pirates uniform. So a little upset by that, but we'll move on. My name is Corey Hoffstein. Before we get started, just want to remind everyone that this is not financial advice. This is 2 guys just chopping it up on a Friday afternoon. Even if you're not listening on a Friday afternoon, all of that still holds true. Do not take this as advice. It is poor advice at best. So we're going to leave that there. Jason, am I missing anything, or can we just dive right into the show?
We could probably dive right in, but as you know, it means 1 in, 1 out. So I told you with that sweater, I'm probably, that means I have to give up something else. So I'm not sure if that sweater's going to make a cut into my my travel bags, but we'll see. There's always hope for it.
Might not make the cut into your that was a gift.
It didn't make the cut this time.
That is insulting. Okay, look. I think last week we talked a little bit about my experimentations in TikTok.
Yep.
And that I felt like the algorithm was just playing me. After weeks and weeks of posting, it started to bump up my views a little bit, and then it gave me a couple of views in the thousands, and I got that dopamine hit, and I was like, people like me. They don't. The next video plummeted back down. Algorithms just messing with me. And I saw this great Twitter post by a woman whose name I'm blanking on. I know I sent it to you. We can pull it up in our DMs. But she was basically arguing that TikTok has almost perfected the casino algorithm, the slot machine algorithm. So I didn't realize this, though I think I'd learned it at one point. Slot machines are actually where the majority of time is spent, and a significant amount of profit is made by casinos. And most people sort of poo-poo slot machines, but there's this psychology behind slot machines that the random dopamine hits that occur with the slot machine, with the absolutely randomized payouts and the random time intervals between winning, causes people to want to keep pulling that lever. And when you think about the way that TikTok has designed their algorithm, every swipe is sort of like a pull of the lever. And they don't just give you banger after banger of great content. They give you a lot of shit content along the way, right? And it's sort of like pulling that lever and just not winning. And then you get that great hit and you go, wow, that was awesome, so funny, or such great content. And then you're addicted for the next hit. And it feels really nefarious, Jason. Now that I really think about this, and I go, man, designing algorithms for social exploitation, purposefully giving people bad media to keep them hooked on your app longer. Like, part of me wants to believe it can't be true, and then part of me goes, that absolutely, like, if you are designing algorithms to maximize participation, whether you intend to or not, that's probably the way it's going to fall out. So I don't have really a question here, but just want your thoughts.
No.
My wife operates in the world of social media and is very sort of concerned about the way social media is impacting teens, and that's a huge part of her job. Thinking about the way these social media companies are engineering their algorithms to maximize participation, sort of creating this zombification of users, and I am not outside the circle of people who are affected by that.
Yeah, I want to say my phone's across the room, but I think it was Liz Borey. It was like,
yeah, that sounds right.
There's so many things in there that you said, like, yeah, the obvious way that TikTok is doing, and I've seen it happen to multiple people. But then I don't think you've ever probably taken enough time off of Twitter. Have you ever taken a few days off of Twitter? When you come back, all of a sudden, like, your followers and everything goes up because they're trying to get you back in. I just wonder, like, once again, it starts to beg these questions that makes you feel like a hamster on a wheel, right? Like, do I have free will, or am I, these incentivizes? And I think about, like, what always crazy to me is, like, think about somebody who studied like astrophysics at MIT, and then they get like a job at TikTok, right? And they spend all their day just maybe trying to change the color of a button or changing the algorithm slightly to get you more and more addicted. And this is what they, they went to school like for 12 years to get a PhD, and this is what they spend their time on. So once again, I say that also is like, we're no match for them, right? There's no way we can compete with that. And what I'm saying is like, what's interesting in like Silicon Valley is like, they must be sitting in those offices just laughing when people talk about free will, seeing that all they have to do is slightly change something, and we're just like rats in a maze and just hitting that button.
It reminds me of a conversation I had back in the heyday of robo-advisors, and having conversations with people that work there that talked about how when you changed part of the user interface, it would actually change the behavior of people who were interacting with the robo-advisor. So one example, I think this Betterment even published this one. They talked about how they displayed their global asset allocation. And if they took all of the foreign countries and labeled them just foreign developed in the asset allocation, users would complain that there was too much of their capital invested abroad. They wanted more in US equities. If instead of labeling it all as foreign developed, they broke it out into all the individual countries, which looked way smaller than the US, they would say, wow, there's way too much overexposure to the US. I want more invested in foreign developed. Same exact asset allocation. It was merely how it was labeled and displayed led to a change in desired behavior among the investors. My sort of initial gut reaction was, if you are in the world of finance and you are experimenting on your users through your user interface, when are you violating your fiduciary duty? Right? Can you, if you have a hypothesis that changing a button from green to red may lead to a worse outcome, are you allowed to test that? Because if you test it and you're right, can't you say, well, you were doing something that you thought would be bad for your users, and indeed you proved it was bad for your users, and that's against your fiduciary responsibility as an advisor? Right? So you sort of have to say, well, I don't have a hypothesis, would be the legal protection there, and you're just trying to test for things that improve the outcome for investors. But it gets a little weird, in my opinion, when you start doing this A/B testing in the world of finance, right? What your legal and moral obligations are.
Yeah, by the way, Max in the comments said it was Liv or he. So like, thanks Max for correcting us on that. But do you think they're able to sleep at night because they justify it as like that nudging allows their clients to create better portfolios or maintain their portfolios better, like almost like reduce that babysitter tax of why we have fiduciary or financial advisors, and that's how they would justify. Like if you're working at that firm, they would say, yes, we are kind of messing with the algorithm, but this is in our client's best interest. And whether they know that or not, objectively is a whole different story. But that's maybe the way they justify it, the way they're thinking about it. But like you said, the other thing is the fiduciary responsibility side, as you and I both know, is like the regulators and stuff are like kind of way behind on modern technology. And so like, I don't, there's certain things like when you take, tests for like the NFA or whatever, it talks about like newspaper and radio ads. It doesn't talk about like the internet at all. So like how far behind, like you're saying, like that is, I never really thought about what you're just saying. It's like, how much does that change your fiduciary responsibility if you're just changing colors or naming conventions around the portfolio construction, and that's nudging the end client?
Well, it's always very interesting to me to have these conversations with financial advisors who, I think a lot of financial advisors would argue a huge part of their value add is being a behavioral coach. And there's all sorts of written literature as to trying to quantify that behavioral alpha, I think is what Vanguard ended up calling it. But in my conversations, it's all very dependent on the end client. So as an example, there have been advisors that I've worked with that have implemented tactical strategies that ultimately said, you want it, the clients don't want to see all this action. They've really bought into, inaction as being valuable. We need to hide all that action that's happening within a ticker, a single ticker. Just had a conversation with an advisor this week who said the exact opposite, who said, no, my clients really want to see a little bit of activity within the portfolio. Now, this is where things get really interesting, because if you take a tactical strategy and you wrap it up in a single ticker, what that allows the client to do is they no longer see all the tactical changes that are occurring, but it'll be painfully obvious at the end of the quarter or the year exactly what that tactical strategy is contributing to the portfolio, because it's all summed up in that one little line item in the return, right? Right or wrong, thinking about portfolio contribution, you shouldn't analyze the line item, but that's what they're going to see. That tactical sleeve is in that one fund that's doing all the tactical changes, and the return is crystal clear. If, however, you unwrap it and the advisor runs the tactical strategy themselves, and they're buying and selling all these different ETFs or securities, well, there's no real way for the individual to sort of isolate that part of the return in their portfolio compared to the rest of their portfolio if it's only a sleeve. And so there's all these games, and I hate to use the word games because it sounds nefarious, but there's all these considerations that have to be made when you're running money for people as to how they are going to ultimately see the results. And the way you manage money may change based upon the way they see the results and how you think they might react to that. Do they want to see it isolated? Do they want to see all the turnover and changes? Do you want to hide the contribution? Or do you want the contribution to be crystal clear? None of it's necessarily obvious until you sort of figure out the type of client that's ultimately allocating. But these are all trade-offs that the return can be identical of the actual strategy, but these can all lead to very different client behavioral outcomes.
Yeah, it's interesting. I don't want to name names on platforms, but it's always interesting when you're talking to clients or potential clients, and you have them like, they're like, let me pull up my, my account or my portfolio, and they basically can't find any information. It's really interesting how some of the most well-known platforms, it's so hard to like find out how you've done over time, what you actually hold, what's your P&L year to date. Like it's really weird, like the obfuscation around that. But then isn't it Wealthfront, I believe, that will have like a pop-up if you go to like sell something and they're like, there's a tax implication if you do this. Are you sure you want to do that? And they're trying to even nudge them, and they're using the rubric of like tax rebalancing issues.
I think that was actually Betterment.
Betterment. Okay.
I think the only reason I know it's Betterment is I'm good friends with Dan Egan, who was the sort of head of behavioral studies over there for a long time, and I remember him talking about that. But yeah, those little nudges of saying, hey, you want to de-risk. I think it was specifically related to people panicking during a market drawdown and wanting to de-risk their portfolio. And what Betterment would do was say, if you make this allocation change, say from a 80-20 to a 60-40 because you're feeling panicked, it's going to incur this many specific dollars in taxes. And by quantifying it in dollars, people are so averse to having to pay taxes and knowing the exact dollars, often it would prevent people from taking that behavioral jump. Now, again, whether that's right or wrong, what if the client is fantastic at timing the market?
Yeah.
I don't know. But it's interesting how the display of information genuinely changes behavior. And it's something we don't talk a lot about in this industry, but it's something that comes up all the time for anyone who manages financial products, because it's this line item risk that we're constantly dealing with when you launch an ETF or a mutual fund. Advisors are trying to build portfolios out of funds, but clients are often scrutinizing individual holdings. And sometimes the advisor will say, I am holding this for a great reason, but it's coming up in every single client meeting, and I just can't deal with it anymore. And so I'm selling it, even though it was part of a holistic plan. And that happens all the time because, again, the optimal portfolio is first and foremost the one an investor can hold. And if the investors keep complaining about a specific holding, then the advisors are concerned about the clients leaving them, obviously hurting their business, but also just changing plans, which might not be in the best interest of the client.
And don't you think this is in a broader scope? This is like the argument, almost like it's the friction between Kahneman and Thaler. Like Thaler and et al. Like believe in this nudging and everything, but part of that nudging is being like a consequentialist philosopher, that you believe what is the right move here. And I can't believe somebody would actually think they absolutely with certainty know what the objectively right move is for people at large. And even Danny Kahneman, who's similar on the behavioral side. Danny Kahneman at least admits like he's been studying it his whole life, and he still has all the cognitive biases as everybody else, and he's not sure what would be the right move for everybody at large versus subjective versus objective. And it's very interesting to me because like you're making a really clear, like you're saying, choice. And in hindsight, what if that was the bad fiduciary choice, right? Because we don't know the cascade of those consequences, and they could come back on you 10 years from now and have you reduce that fiduciary responsibility. But remind me of like several other things. Do you, for example, kind of a tangential question was, when people like ask you why, or if you're late for something, do you give a reason, or do you just say like, sorry, I'm late?
So in my opinion, you should never be late. But if I am late,
So-
99% of the time, if I am late and I know I'm going to be late, I try to send a message before I'm late. I have this like fight with my wife all the time. I'm like, if you're going to be 10 minutes late, you know you're going to be 10 minutes late, you should be telling that person 10 minutes early you're going to be 10 minutes late.
Yeah.
Right? So you should never be showing up apologizing for being late, because you should have already told them you're going to be late.
No, but what I mean, I actually 100% agree with you. But also what I'm getting at is like, it's always fascinating because I'm sure you, like I have, you read all this behavioral literature as well. And it's like those ideas of like, when you get up, or like you say you do show up late, everybody loves that reason why, or that because it settles their mind. So like, it's another one, I'll use a different one. Like if you cut people in line and you're like, I'm so sorry, my wife's pregnant. And they're like, okay. But if you cut anybody in line, like, sorry, like they want an excuse. And to me, I'm like, no, you should never give an excuse. You should never give a reason. But then in the back of my mind, I know from the behavioral studies is that's what calms people's mind. Like if you give them a reason, even if it's not a good one, just something that they can rationalize in their mind of why you're doing what you're doing. It's kind of fascinating to think about. And I hate doing that. To me, everything's a yes or no question. There's no because, or there's no why.
Yeah, I just want to point out all these behavioral studies have been like largely disproven as well, or
Exactly.
cannot be replicated. But going back to the original point I was making with TikTok, where I feel like I'm getting gamified in multiple directions, both as a content creator and as a content consumer. It's interesting how some of these things can be done at much larger scale now, right? It used to be, let's get 30 students into an office and you have selection bias and sampling, but all these sort of issues. And now it's like, well, no, some of these studies can be done at really grand scale with much larger numbers that probably make them much more replicable as studies. There will always be selection bias with all of this sort of stuff. But at the end of the day, like if we ultimately learn, hey, you want to know what? If you make the buy button green and the red and the sell button red, it invites different behavior than they're both white. And we can document that. And it's good behavior. Does that mean every advisor and platform should be conforming to that? Right? And once that knowledge becomes public, like it sort of invites this very interesting question of what it means to be a fiduciary when that knowledge is out there.
But then as you were almost like leaning into it there, is like as it changes through time and that knowledge gets out there, does then that landscape change and now it's blue and yellow buttons, right? Or like we're in constant change or flux. Like you would think at this point though, we'd get over like this whole like pricing of like $5.97 or $5.99, but still like the behavioral biases, like, so you still have to you have to acknowledge them, even though they're completely ridiculous. Like you still have to acknowledge them. And part of that is I want to bring it around to this podcast I was listening to this week, but like there's all these subtle clues. And if you work with like e-com people, especially, is all those A/B testing, right? You eventually get down to what works, and whether people have free will or not, but you're just trying to do what works. And then like if you apply that into the financial institutions and their websites and their platforms and portals, I hadn't really thought about like the fiduciary responsibility of what color you're making your buttons or how you're displaying your information. But also I think about, you have all those subconscious processes that asking you if you have free will, basically. By the way, one of the ones I know, I figured out how you can increase your TikTok. You're almost there. It's muzzies and mullets. So
go on, continue.
The kids these days, I saw it on my YouTube feed. It was there's a newer YouTube channel called like the Boys of 98. It's once again these guys just going, they're like in their 20s, obviously early 20s, going around to colleges and just partying it up. But all of them have mustaches and mullets, and they're at like Michigan State University, and the guy's like, no, these you guys have muzzies and mullets, so these sweatshirts are on us. So you've got the muzzy, you're just missing the mullet. That's why the TikTok.
I just trimmed all this too. I didn't know I could have had a mullet.
But I was also thinking on the behavioral side. So, I always read those studies my whole life about like CEOs and everybody too, always being over like 6'1", 6'2". So I was like, man, that's just unfair. So you got that nailed. I'm only 5'9" on a good day.
It's good of you to admit that.
No, well, I'm probably actually like 5'9.5". I like to round down. Let's be realistic. So you've got the height, but then you've ever read the studies on like eye color? So I have brown eyes, and allegedly people trust people more with brown eyes than they do with blue eyes. So there's always, like, whether it's a website or not, these are all subconscious processes. But like you referenced earlier, I'm 100% with you. A lot of these studies are non-replicable. So let's deal with that. And speaking of replication, what was fascinating is, I assume you read like Outliers by Malcolm Gladwell or any of Malcolm Gladwell's books. So they were doing Outliers Revisited. Okay. And like you said, a lot of this stuff's not replicable, but I'm already going to give away the answer before we start. But like I assume you read about like the Canadian hockey players and birth year, like birth date, birth month.
It's been a long time since I've read Outlier. So why don't you refresh me?
Yeah. So what they figured out is like, almost all the guys in the NHL, it was called 40-20-20. So basically, or that doesn't work out. So, I think it's 60-20-20. Sorry, it's like, or it splits out 40-20-20-20. It's almost the majority of the NFL players are born in the first quarter of the year. So if you have that more time to develop when they're starting to segregate you as 4 or 5 or 6 year olds, you're going to be more physically, emotionally, psychologically, mentally mature. And so you just already get, pushed down this path where you're ahead of your peers, and it automatically self-selects then from like the age of 5, people that are born in the first quarter of the year. So it had this interesting effect. And so, even though Gladwell wrote about it, a long time ago, by the way, just for anybody in a rage yelling, in the Booty Crew, anybody yelling at their YouTube right now. No, I'm not a huge fan of Gladwell. Almost everything he says is non-replicable, but we're just having a conversation here. And so that's what they found time. And then you would think the sports have gone back and changed. So they wanted to revisit it. And they checked like hockey players and some other sports, and it all fell into the same thing. Is the majority of the professional athletes were born in the first quarter of the year, and especially if they were segregating on like calendar basis. But what's interesting is to kind of go and revisit the study. He went to UPenn and went to Wharton and got a bunch of seniors at Wharton together in a room. And they had them fill out this questionnaire as an experiment. It was like a 12-part questionnaire. They had to actually essay fill it out and everything. And they said, thank you for filling it out. Now, if you would write your name and your birthday at the top of the paper and hand it in. So they go and hand it in, and there's 2 people collecting them at the front of the room, and they're just watching them go through it in like 5 seconds, give somebody a score. And then with that score, give them for their score number. And like 5 seconds on the next one, score number. So then Malcolm Gladwell asked the seniors at Wharton, what do you think they were, you saw how quickly they tested you or whatever. What do you think they tested you for? Like, what does your number signify? And some people were like picking, one of the questions was like, did you have a tutor when you were young? So they thought it was maybe that, right? Or another one was like, ask them if they have ever like drank to black out or something. So another one thought it was that, right? So they're all guessing, and none of them are figuring it out. And, eventually he's segregating them by these numbers, right? And then we have that endowment effect where like now people are like, well, I have a high number because, I really excelled in my special classes or whatever. And then they started going through this privilege, and the selling girl was like, well, as fortunate as a white woman, I had to understand my privilege is why I got a high number. And so they're going through all these narratives, right? And eventually, I knew right away because of this, the athlete scenario, because I remember Outliers. It was just based on birth date. But I guess apparently, I did not know this because obviously I don't have kids, is now a lot of the helicopter parents have figured out that if they hold their kids back in kindergarten or first grade, they can start a year more mature, and then they'll get more work with the teachers, they'll get more tutors.
This is classic efficient markets.
Exactly. And so then the question at the end is like, now are we holding back first graders till they're 6 or 7? Like, do you go another year? Like, how are you doing this? So basically, right, all of these seniors at Wharton were like 22 years old. They were like a year older than they should have been. But it was interesting. So he tells them, he eventually gets down to that, and then he starts asking them, okay, if we could rectify this and like figure out different ways to make sure you weren't just advantaged because of your age when you entered kindergarten or first grade, would you want to change this? And once again, endowment effect, these kids were like, no, I don't want to change the system. It's like, it's worked for me. I'm winning here. I'm at Wharton. And it was really interesting. Like, none of them actually, like, we're all arguing on why you shouldn't change the system to be more equitable.
Well, in theory, I guess, I mean, if everyone's doing it, right, you get back to everyone's holding their kid back, and then it should just become equitable unless someone decides to hold their kid back 2 years, right? So it sort of becomes a question of like game theory in a certain way, and again, tying back to efficient markets. But it is interesting. I mean, like any young man who went through school, in middle school, that the boys who hit puberty first are the ones all going to play varsity. Like, it's just how it worked in the early years until everyone caught up, and that's just the unfair name of the game, right? And so the kids who were older got pushed up. They played more advanced earlier. They learned those skills faster, and yeah, that stuff snowballs. It absolutely snowballs. And I'm a big believer in the snowball effect. Did you ever read the study? I think it came out of Columbia, where they talked about the snowball effect and Justin Timberlake.
No snowball effect. I don't think I know snowball effect and Justin Timberlake.
So this, well, it was basically about music. So the whole study was about music. So this is probably one of my favorite studies that I am ashamed to say I don't like. It's one of my favorite studies, and I don't know the authors. But basically, the study was all around: is good music intrinsic, right? Or is there something else to good music? And so what they did is they created this music platform, and they took a couple cohorts of people. They put half the group in a blind rating. So you could listen to music and you could rate music, but you couldn't see how other people rated music. And then they basically put the other half in a group where you could see how people rated music, but they took that second group where you could see how people rated music and cut it up to a few subgroups. And so the question was, are you influenced, right, by the way other people rate music? Does the same good music come to the top, and would people ultimately end up rating music as being good? And here's just what ended up happening. None of them agreed as to what was good music. The blind rating group had totally different ratings than the groups where you could see ratings, and each of the groups where you could see ratings had wildly different ratings on music. And you might say, well, it's because all the groups had different tastes and preferences. Well, the groups are pretty big. Like, that shouldn't have been too much of a selection issue. What they found when they looked at the groups, oh, by the way, the group where you could see the ratings were much more skewed. Like, there were massive outliers in popularity versus the ones you couldn't see ratings. And the groups where you could see ratings, those subgroups, what they found was music that got rated up earlier was more likely to be listened to and rated by later participants. And so there was this snowball effect. If a song just so happened to get a little bit of popularity, it would get more recognition, more ratings, which created more recognition and more ratings. And so it became a runaway winner. And the runaway winners were different in each of the subgroups. And so the big question was, is they're going to use a star. Is Justin Timberlake good? Or did he just happen to be in the right place at the right time where someone picked him up and he's just a runaway snowball, right? And the answer is probably both, right? You probably have to clear a minimum threshold of talent in some of this stuff. But then there is this societal snowball with the public ratings, and someone gets popular and they get shared and it increases their popularity. So obviously in my brain, I tie it back to markets and that sort of stuff, and economics and finance and business, right? But there's this really interesting documented snowball effect when it comes to popularity. And I think that's probably why you see this sort of, it's the same with memification of ideas, right? And you see these sort of runaway businesses that beat their peers because they were first mover advantage. Like, it's all very much, to me, interconnected.
Well, yeah, so I think a long time ago when we did that whole episode on like the carry trades book, it was that first mover advantage, and people don't realize. And then I'm tying it back into like finances, like what we talked about last week too, of like, the first year that you're in business as a hedge fund, if you knock it, you crush it, now you just, the survivorship bias is like unbelievable for that first year, like first mover advantage kind of thing. Like, it's always about, I'm missing the right phrase exactly for what that means. And then part of it, I actually think I thought you were going with the Timberlake one. It's like the one I always love was like the Maroon 5 one, where they put Maroon 5 on either side of like new music. And because like there's something about Maroon 5's algorithm that makes people like enjoy it or catchiness. It's like the good by association. If like you put it between two Maroon 5 songs, it's like how it would catch on. But let's get, like, we're talking about behavioral stuff, which who knows, like you're saying, like, who is Justin Timberlake good, or did he get lucky? And the whole point is you'll never know. But
right. There's no counterfactual to be tested, right?
Right, and we'll take the luck every time. The other thing I want to point out that you were talking about that relates to finance as well is, like, even though we try not to relate it to finance, is Cauchy curves, kurtosis. And so especially the internet like exacerbated this, is you have severe winner take all effects with fat tails. So everybody talks about the long tail or fat tails, but part of fat tails too is then you're pulling up the center of that curve. So it's true, like, Justin Bieber is going to sell so much more than everybody else combined, but then you still have fat tails. So people don't realize when you change from from Gaussian to Cauchy, like you're pulling up the winner take all effect, even though you can still make money at the wings. And that affects also like, you know, you and I would deal with options trading and everything like that. And, you know, that's part of the process we have to think about too all the time is kurtosis and leptokurtotic curves and stuff like that. So like try to pull out all the fancy words.
Total change of subject.
Yeah,
back to TikTok, just to annoy everyone who's listening. I think I sent you this, but I saw what I thought was the most brilliant engagement hack of any content producer I had seen in a while.
Oh, yeah.
So these guys, and I thought this was so brilliant. These guys decided that they were going to play a round of mini golf. And this was, I realized later, this was for a golfing related TikTok account. They were going to play a game of mini golf. They claimed it was for, there's 4 of them playing. They all claimed they put $125 in, $500 winner take all. That was said within the first 3 seconds of the TikTok, right? And then what they did is they created a video for every hole. So they play the first hole and they sort of did edited and they gave play-by-play how people were doing. And at the end, it was the score. And it said, if you want to see how, you know, the rest of it turned out, keep watching. And so what I thought was brilliant was, one, immediate quick engagement. You hear them playing for $500. It's enough money that you're like, oh, this is sort of interesting. Were they actually playing for $500? Who knows? The internet's full of liars, right? But quick sort of gets you engaged. And then they play the hole, and it was good enough content that you might watch through. And so, okay, that video gets promoted because you're getting a lot of people to watch, or at least watch long enough. And then someone goes, oh, I want to know how this ended. So maybe they jump to hole 18, right? They go to the profile, they find hole 18, they watch. Great. You just got people to interact with your videos twice, and they watched all the way through. That's going to help promote your content. But maybe someone goes, hey, I'm going to jump around to a couple of these videos. Or maybe someone watches all 18. Right. And it was the idea to me of taking this like very mundane concept that's very naturally broken down into pieces, right? 18 separate holes that could all be their own video, that if you want the full story, you need to watch all 18 videos, which is like supercharging their engagement metrics. So in my opinion, Pirates of Finance should no longer be an hour-long show that's posted all at once. We need to like figure out a way to break this down into like 1 minute, 61-minute videos that someone needs to watch all 60 of them, because our engagement would go through the roof.
Yeah, but neither of us are creative enough to come up with cliffhangers for each video. It's like, I was thinking, it's like, before you even brought it up, I was like, almost like a game of Clue or Knives Out. It's like, you got to have those cliffhangers. And that's why, like you said, they built it in with playing the putt-putt for money, because you want to see what happens. So like, that's what I was going to ask you. Is like, did you come up with a system where we could have cliffhangers, find out what happens next, or you and I bet each other on something? Like,
no, but I thought what was brilliant about it, right, was like, for me at least, when there are cliffhangers that are done in videos that are transparently cliffhangers for engagement, I find it annoying. Yeah. But you couldn't blame these guys because it was a natural break, right? They can't do all 18 holes in a single video. That would never work. And I get that, like, they could sort of do a summary 3-minute video, probably not that interesting at the end of the day. Like, the per hole break was such a natural way to break the video. I thought it was such a brilliant engagement hack, to the point where, like, I have to believe it was on purpose. Maybe they just like lucked into that approach. But you know, probably the way the world works, they probably did just luck into that approach. But like, to me, it was like, what a brilliant engagement hack to get exactly what you need the algorithm to see, right? The algorithm needs to see people watching for an extended period of time and continuing to want to engage with your specific content.
It might not have been luck too, because if you ever looked at like what Mr. Beast does and everything, like he has developed a system over time, and like he doesn't even put out certain videos if he can't perfect a thumbnail.
I know, but Mr. Beast. All right, so let me well, and he's been at it for a long time, and he's obviously very thoughtful and dedicated. This was a group, I checked out their profile, that didn't have a large number of followers. So to me, it said they might have stumbled into something accidentally. Maybe they had some foresight. But it's also one of those, right? The algorithm will reward organic things. And look, there are millions and millions and millions of people on TikTok trying stuff. If we think of the algorithm as sort of search optimization, right? It's just moving along the surface of videos, trying to find what's engaging, and then it'll keep promoting that stuff. Well, if you just happen to stumble into a good engagement hack by mistake, right? TikTok's going to reward you whether it was on purpose or by mistake. At the end of the day, that's bound to happen to some people, just fooled by randomness. They go, I sit back and I go, that was a brilliant engagement hack. Well, no, they just did it accidentally.
And yeah, but I also want to give the caveat that you and I are both aware that, you know, maybe TikTok is just one big ruse to get all of our facial recognition data. So we're not like totally naive on that sense. But there was another thing, like the guys from My First Million, but this has also been a kind of a common conception for a lot of people these days. And I'm curious your take on is like, yeah, they were saying, and I've heard a lot of people say this, is like the best entertainers on the world are on TikTok. And then almost like Roger Mitchell from Are You Not Entertained also talked about like the memes with the quotes and everything is like, and even the comments on TikTok or whatever, is like, these people are like some of the most entertaining people in the world because within like seconds they can grab you. And obviously the algorithms, you know, affecting that change. But I'm just curious, like, you know, obviously some people, it's whatever you prefer. If you prefer long form on podcasts or whatever, but like you can't hate on like the ability to capture attention at the highest level is like really getting funneled into those like TikTok creators and also the people that comment or create memes, like the different things going on TikTok.
Yeah, it does strike me at a certain point though as like weirdly nefarious, right? I always felt this way around sales. So sales is a skill that you can learn and you can read all sorts of books and practice sales techniques. And you read a couple books on sales and there are things like mirroring, right? Mirroring behavior. That's a classic sales technique that when you learn and you see someone doing it to you, you go, are you doing this to me because you just naturally do it? Like there are people who learn these skills organically that don't even realize what they're doing. And they just happen to be naturally good salespeople. And then there's other people who know what they're doing and they're trying to exploit the behavior. And that's where I go, this is gross. Right. And I actually struggled with that for a long time when you learn these sales techniques and then you start having to sell because all of life is sales. Right. And you start having to sell in something and you use a technique and you're like, that's really gross feeling. Like, I feel like I just mind hacked someone and I don't like that I took advantage of a weakness I know about them, you know, about just people in general. And so it's this weird, like, moral and ethical issue of like you can clearly manipulate people into doing things and knowing you're manipulating them like somehow makes it way worse.
That's my least favorite one that I can't stand that these people will do is let me tell you something, Corey Hoffstein. What you really need to understand is like when they put your full name in there because they know they've learned that's a hack for people are like, oh my God, you said my name and I'm so important.
Right.
Like it's so gross. Anytime I hear somebody like, dude, like in a conversation when they say your full name like multiple times or every few minutes, like it's so gross. It drives me absolutely crazy. But it's also almost like it's all that nefarious stuff is like the guys learn like from like pickup community, like to like nag girls and all this stuff. It's like you don't need all these hacks, like you know, like just you know, and it's amazing. Like I don't know how people do that. How he could systematize it that much, but I mean, I guess Mazel Tov because like you said, is like I think even Daniel Pink has wrote books about this. Is like everything in life is sales. You know, and I know people like me, like I know growing up, is like, I don't want to be a salesperson. That's like a used car salesman. Sales are gross, right? And it's skeevy. But then you realize like to do anything in life, to start a business, to have a significant other, it's all sales. And so, you know, but you could still not use all these tips, tricks, and hacks to manipulate people in a nefarious way.
At the risk of pissing a lot of people off, I think this relates to like politicians as well. And I think Donald Trump in particular, right? I think a lot of people ask, well, is he a great politician, right? Does he knowingly do some of this stuff to manipulate his base or get his base excited, right? As a politician should, or does he unconsciously do some of the stuff he does, right? And does that change whether it's good, bad? Like if you are a politician and you're knowingly doing things to get your base excited and like it's in a manipulative way, was that okay? Your job is to kind of get your base excited about things, right? You know, does that make you better or worse if you're doing it organically or these are learned skills that you're very aware of? Like, I don't know. These are big open questions for me. And again, as sales is part of life, and especially when you run an asset management firm, sales is a big part of what you do. You know, these are moral and ethical questions that I think every business person has to face at a certain time. Where is the line as to what you're willing to do to get a sale?
Yeah, like you said, like the politicians' populism, right? And they're appealing to their base, or they're almost playing like 3D chess that I can't understand either. But like, I think it was on like maybe Russ Roberts on like Econ Talk was talking about what the politicians will say anything, and he was talking about Twitter in general. And I realized I'm probably an idiot on Twitter because like he was like talking about people getting upset or this politician said this or whatever. And it's like, yeah, they're using Twitter. They're not talking to you at a coffee shop. This is how they're like projecting out to their base and millions of people. And I'm like, oh, I'm kind of an idiot. Like I use Twitter. I don't use it as well as you do. I use it like I am talking to you at a coffee shop. Like I think I'm making a human connection. I'm not thinking about this is how I should be crafting a message for my company or something like that. So I'm saying I'm an idiot the way I use it, though.
Well, but you and I have spoken about this in the past, right? There are certain accounts in the financial Twitter space that have gotten incredibly big over the last 3, 6, 12, 18 months, right? And they clearly do some of this engagement hacking.
Yeah.
One of the most interesting being like, you just tweet more, you get more followers. Like there's a clear, if you take all of FinTwit and you just sort of, right, you just plot number of tweets versus number of followers. Like there's clearly a positive correlation there for the most part. And I would sort of argue like above and below a certain threshold, you start to talk about signal versus noise, right? You have a low, low tweet count and a high number of followers, you probably are either a celebrity or you have a lot of signal, right? You do a ton of tweets and not a lot of followers. Well, that's probably a lot of noise, right? So at the end of the day, but you definitely see some correlation there, but there's like fighting with people on Twitter, weirdly enough, gets you a lot of engagement, which gets you in front of a lot of eyeballs, right? So people who are picking fights all the time, memes, all that sort of stuff, right? Twitter rewards engagement. And so you can hack it to get more engagement, get your tweets put in front of more people, which will get you more follows. Now, the question you and I always ask is are those the follows you want that help your business? Right? You and I, despite the fact we're doing a public show here, like I do not cater to individual investors. That is not my business. And so I don't, like, I'm happy if an individual follows me and likes what I talk about when I talk about quantitative investment theory and portfolio construction and all that sort of stuff. But at the end of the day, I don't have any services or anything to offer them. So that sort of follower doesn't really help my business in any way. And so, for my account to get lapped by some of these other accounts that I see are, getting a bunch of people to follow them, it doesn't really affect me all that much because I kind of go, I could have another 50,000 followers, but if they're the wrong followers, it doesn't help me.
Exactly. It's depth over breadth. And both you and I have talked about this many times before, is like, it's actually the DMs and everything and the relationships we build is actually our biggest alpha from Twitter. Is just the other relationships we build with other people. Not necessarily.
There's a lot of alpha in that, but there's a lot of negative alpha in the time wasted on Twitter. I'll tell you, sometimes it feels like I don't know if I'm winning or losing.
But just like you're saying from TikTok, because they're manipulating, your synapses and giving those dopamine hits. But I want to change a little bit on speaking of Twitter and memes and all that stuff. Some asshole on Twitter the other day put out a meme about people that want to start an ETF and asking him, and they think it's their road to riches. I'm just going to, I don't know who that asshole is.
Yeah, well, he's an asshole. Well, okay, so on that same topic, that asshole was me. And I put out a little meme that was, what is it? It's the Arrested Development meme, people put out ETFs all the time. Well, does it work for them? No, it never does, but maybe it'll work for us. I mean, the ETF space is so insanely competitive.
Yes.
And everyone thinks that they have a great product idea, and they do not realize how little that has to do with your success, right? What matters is, yes, clearly the product matters. The timing of the launch of the product matters a tremendous amount. Your distribution plan matters way more. Do you have seed capital? Is there going to be volume? Who's your primary market maker? Are you good at trading this product? All of that stuff is a huge part. Like, just because you launch a product doesn't mean anyone can buy it. That's what people don't realize. You can launch an ETF. Guess what? Most financial advisors will not be able to buy it day one. You will be off every major platform. Maybe people might be able to buy it in their brokerage account at Schwab and Fidelity. Maybe. Fidelity's tough on mutual funds out of the gate. And people who are super interested in investments, and this is a theme you and I come back to all the time, like, investment management is not asset management. You can love coming up with investment strategies and picking stocks and whatever you love doing, that does not mean you can run a good asset management firm. They are distinctly different things. And everyone who talks to me about launching an ETF typically comes from the world of loving to be a portfolio manager. And they have not considered all the other infinite shit that goes along with actually managing a 40 Act vehicle. 40 Act vehicle being 1940 Securities Act, mutual fund ETF.
I would say at best they're a portfolio manager, but most of them are just entrepreneurs, because the same applies to every business. And we talked about this before, is like, you have to have a distribution model. Who's your buyers? I like to pre-sell everything we do. I don't like to guess and think I'm going to go into stealth mode and build something for 2 years and then unleash it on the world. And they're going to thank me and glory to the heavens, and everybody's going to run with fistfuls of dollars and please take my money. Like, the world doesn't work like that. And so part of it, though, let's kind of break it down in raw numbers, though, for anybody that is listening, that thinking about it, is like things you have to consider. It probably costs about $250,000, these just rough numbers, $250,000 to start an ETF. You're going to need a $5 million seeder for anybody to even take it seriously, to even start to make a market on it. Then you start thinking about, okay, if I'm charging 59, 79, once again, the 99 bips, like, okay, I probably have to get to 50 to 100 million for that to even start to break even. Because not only is it $250,000 to start, your regulatory burden every year is another $250,000. Then you have all these other people that you have to worry about. Then the next question is like, how do I get on these platforms? What is my distribution model? All of these things. Do you have basically 3 to 5 years of cash flow to make up for the point you're going to finally get where you're actually beyond break even and actually can make a return on this product? And that's what I assume your meme was about, is like, people just don't get through. They're just like, oh, ETFs are awesome. Let me launch an ETF and everybody will love me for it. But I think, correct me if I'm wrong, like the BlackRocks, and more BlackRock than maybe Vanguards of the world, they'll throw out like hundreds of ETFs a year and then just chop the ones that don't work. And they obviously have the money and distribution model. So once again, like you're saying, I always ask people, like, people even in our, like, around our firm and all that stuff, is like, they, want to do an ETF. And I'm like, do you realize how much of a bloody ocean that is of competition? Like, you were going to compete with these behemoths like BlackRock, Vanguard, State Street. I mean, it's just like, what do you do? Like, you better have a real tight plan.
Meb Faber used to say, if you want to launch an ETF, you better have 5 years of capital. He now says you better have 10 years of capital. Right, this is a long-term game, and you see these ETFs that'll languish for 7 years and then suddenly bring in $1 billion because they're at the right place in the right time, and they finally have some platform access and demand, and the market cycle's right. Like, it is a long, difficult game, and like, okay, woe is portfolio managers and asset managers. I get we don't have a lot of sympathy for them, but the grand point here is, like, launching these products is much more of an exercise of business than investment management. And saying you have a good investment idea is certainly not sufficient to make an ETF or a mutual fund successful. It is, Eric Balchunas calls it the ETF terrordrome. Like, when you go to launch an ETF, you are going into one of the most competitive, overcrowded spaces. And you have to fight for shelf space, and you have to fight for your life. And you are at a huge disadvantage as a boutique because you're usually charging more. You have less distribution, right? You're just not going to be as trusted as a boutique. People are going to want you to prove it. You raise $5 million in assets. It's hard for an advisor to be a huge allocator. So you're going to start getting little tickets that are 250, 100 grand, right? But most advisors want to keep a consistent book. So what you have to do is go find those advisors that are writing individual tickets, which are harder to find now. Most of them are running on model portfolios. So it is just incredibly hard to get new product off the ground. I have a huge amount of respect for anyone who does it, but everyone who's keen on learning more about it, like, you need to realize, like, you have to have a very strong distribution plan. I want to pause there because I could go on this for hours. You know me. Like, we've talked about this not live. I want to take it a different direction, though, because there was a new ETF that was launched. It was called a low vol ETF. It inspired a conversation from someone who asked me, the whole theory about low vol and min vol is you can buy a basket of lower volatility stocks, and they actually, due to leverage aversion, have a higher risk adjusted return. And the problem is, though, that higher risk-adjusted return comes at a lower volatility, so the total return doesn't even necessarily meet the market cap. Like, it's higher risk-adjusted, but it's lower vol, and so the total return is actually lower than if you just bought the index. So in theory, to exploit that, you need to lever it up. So this person asked me, well, how come there are no levered low vol or levered min vol ETFs in the market, right? What you would need to do is take like USMV and lever it up 1.25 times to really squeeze all of the juice out of the min vol story. And I said, well, ironically, the answer is probably leverage aversion, the very thing that makes the min vol anomaly exist in the first place. And I couldn't when I said it, I was like, this feels like the most ridiculous answer.
Yeah.
That we're creating a product that's supposed to be taking advantage of leverage aversion, but we don't actually get the full benefit because of leverage aversion. And I don't know, there was something about that I just said, like, this feels like it sums up the industry to me. And that makes me sound very negative on the industry, but it felt like I was like, this is sometimes like where my frustration with the industry is like, we clearly know the answer is we need to add leverage here. And the whole industry is so against leverage in every way that like we end up just launching a product that's clearly suboptimal.
Do you think the primary example of this that you could point to, though, is like Berkshire Hathaway? Some have made the argument that he basically takes low vol stocks and levers them up 1.6 times. And if you overlay that with a similar P&L, it looks broadly similar to Berkshire.
Yeah. So AQR wrote a piece called Buffett's Alpha, which is a great read. And basically what they identify is that, yes, through the insurance float, Buffett is able to lever up his exposure to defensive style stocks, high quality min vol style stocks. And that explains the vast majority of his performance alpha. Now, they don't say, hey, that's he doesn't have skill, because the reality is he realized to do that many years before these were documented anomalies. So like, this is not a knock on Buffett's skill. It's a post hoc, attribution, knowing that this anomaly existed. And yeah, so I guess you could just say just buy Berkshire, maybe. But
no, I'm saying like point to that to why it actually should work.
Yes. Yeah. And yet no one does it because, again, there's the leverage aversion. People have tried to launch lightly levered ETFs. There's a ETF that came out that was 1.25 times levered. It went nowhere. It's either like you got to go high octane 3x daily or just don't lever at all.
I was also thinking about when you were talking about the ETFs too, is like so many similarities of like, my family's like the restaurant business and stuff too. It's like everybody wants to be a restaurateur, right? And it's like, what do you know about restaurants? Or like, I'm a good home cook, or like I throw a great dinner party. I'm like, are you out of your mind?
Buddy,
like,
I hope you're looking in the mirror. We're talking about launching a rum company because we like rum. Like, let's pot calling the kettle black here. Like,
no,
let's acknowledge our own flaws.
No, I was gonna get to how dumb I am. And so like if we're talking about like ETFs and everything, I'm like how funny it'd be if it's also like that marks like peak ETF. Like, we're like inversely correlated. Like we're your example of what not to do in a sense is like, and they also say, because like you build all this ETF product, you're trying to bring it to market. Watch it be like peak ETF, and then all of a sudden all that passive target date funds just blow up, and everybody floods back into active right when you moved into like an ETF style product suite.
Yeah, I don't know if that'll ever happen. I think there's so much tailwind behind ETFs for the potential tax benefits. By the way, that's another thing I should add. I find that this is like a deeply misunderstood concept. Just because a strategy is wrapped up in an ETF does not mean it will be tax efficient. The wrapper itself does not create any tax efficiency for the strategy. What creates tax efficiency is the create-redeem process that the ETFs have with market makers, right? And so they are able to take, when they want to change their holdings, they're able to work with market makers and basically do almost like an asset swap, where they are able to say, these are the stocks I want, and they get those pushed on them, and they're able to push out the stocks they don't want. And those stocks ideally are their, low cost basis, high tax stocks. And they can actually do what are called heartbeat trades, where they literally just like sort of get the same stuff in and push their low cost basis stuff out. And it's a tax loophole because for market makers, whenever they receive stock, tax law is written that it gets marked at the cost basis, not that it originally had when it gets pushed to them, but it gets remarked. And so there's this huge tax loophole that's been getting exploited by this process for years. Interestingly enough, there's actually a firm that I just learned about earlier this year that does the same thing for mutual funds. So you can actually, if you have a mutual fund that's got, a huge embedded taxable gain, you can work with this firm to basically say, I want you to be willing to take redeem money, put money in, take redemptions, and get redeemed in kind, where I'm going to push the securities onto you and I'm going to choose my low cost basis securities. And over time, you can actually wash out a lot of the taxes. It's not as efficient as an ETF because there's less of a market for doing it. But it's actually possible in a mutual fund structure as well. It's just not widely done. So my grand point here, that as I continue to rant, is that ETFs are not inherently tax efficient. Like, you need to be careful when you're buying an ETF. It doesn't mean it's suddenly going to be, no cap gains getting distributed to you. You need to understand that they can only wash so much. And so, more passive ETF strategies from larger firms that have really good market maker relationships are able to do this. Smaller ETFs that are super high turnover, that maybe don't have the great market maker relationships, are likely going to end up distributing tons of capital gains to you that you should be aware of.
I was talking about this last night. I'm curious your take. Is I remember years and years ago when I learned about those heartbeat transaction, I was like, this is a scam. This is a grift. There's no way this could go on forever. But then now I wonder if the size is so big in BlackRock and Vanguard and the entire retail public, is there any way they ever kind of close down that loophole on the ETFs?
Yeah, I think, what's the saying? The horses have left the barn.
Yeah.
I don't know. You're the guy from the Midwest. You would know that better than I do. Yeah. I don't know. It would be it's a tax loophole for sure. I'm not sure the way the taxes were written, it was ever really considered that this would take off. But you now have decades of this occurring. And that doesn't mean that, they couldn't change tax law and it would suddenly very dramatically change the investment landscape. So I think you'd have massive lobbying from Vanguard and BlackRock, who are obviously want to keep this in place. They've got a ton of assets that benefit from this. It's hugely beneficial to investors. It's one of the greatest innovations for investors over the last 20 years, right? In terms of creating higher post-cost, post-tax realized returns. I mean, it's a massive innovation. So I think you'd basically have to have the government say, well, we need the taxes and we're going to do it at the cost of everyone's long-term returns. Maybe, but I don't know. I don't know if they will.
I just remembered my dumb idea of the week. So maybe this will be a segment at the end always. It's my Jason's dumb ideas of the week. On the way here, I was reading about monetary operations on my flight because I'm a nerd. And one of the things that was always strikes my mind is, I've asked you a million times, I ask everybody, I don't understand bonds or treasury markets that well. Coming from a port of a commercial real estate developer, I just don't know why they exist. I mean, I know the history. I know about the Rothschilds and Nathan Rothschild, coming up with, bonds because he wanted to unlock all that landed gentry and he didn't want to, finance, monarchs or despots anymore in their wars. So he had something tradable and all that stuff. But then reading about it, it jumps out at me too that it's allegedly U.S. Treasury's $20 trillion market. And it's where else in the world are you going to get that kind of liquidity, right? And then if you think about it, at our local level, if you put money in the bank, your FDIC insured $250K, right? So you're okay, I can put a lot of money in here, but then the whole point is actually if your bank shuts down, good luck. It's going to probably be 18 to 24 months till you get that FDIC insurance. But almost at the same point is you're trying to hold on to this cash or the store of value or whatever you want to call it, a wealth transfer, is no other market has that liquidity in the trillions of dollars. So if that's all that market is providing is a liquidity hold my beer situation for cash you have on hand or Chinese surplus or whatever you want to call it, and it's we should also probably be charging for that. Why does it pay interest? That's when if I put money at the bank, I mean, they're going to lend it out and everything. So I'm going to take all that risk. But even if they didn't, they have to charge for those services to be it's almost like a gold vault. If you put money in your gold in a gold vault in a segregated account, you're going to get vault storage fees. It's almost for sovereign wealth funds or other nations, we should have storage fees for us being able to hold that kind of size for you in something that's close to risk-free. And for the listeners, I'm using quotes for risk-free because nothing's risk-free. But it's a mind-boggling market to me.
Wouldn't that get sorted out in a free market though? right? When they're doing the treasury auctions, wouldn't you basically get to the point where it's like, well, if people really liked the liquidity that much, right, it would just drive rates negative?
You could just demand it though too.
Sure. And then the market would either say yes or no, right?
Right, but where else are you going to put the money? You can't put it in infrastructure products because of the time horizons and the granularity issues. That's what I'm saying. Where do you have that kind of liquidity so you don't have to worry about granularity, time horizons? You could just park it in U.S. Treasuries. I don't know. Like, once again, these are my dumb ideas of the week that like I haven't fully thought through, but I was just thinking about that on my flight. It's just like I just can't understand the market in general and why it doesn't come as a cost.
This does bring up one of my, adjacent to your thought, but brings up one of my favorite topics, which is when someone asks me about like, well, what happens in your strategy when the treasury market blows up? Like, I see you're holding treasuries.
Right,
Like, what
right,
happens
right.
if all faith in the U.S. government is lost and the treasury market blows up? Or like, oh, I see you own exchange listed options. Like, what happens if the exchange shuts down during a nuclear war and you don't get paid out from the options? And I always just think to myself, like, if you are legitimately concerned about my investment strategy under the scenarios of a U.S. government default or the exchange shuts down from nuclear war, like, that's not really what I'm here for. Like, like you need to start like building a bunker, you know?
No,
Like,
it's or like it's people like say it's guns and butter time, but you and I talked before it's cyanide pill time because like I'm not friends with the Blackwater people, so I don't know what my guns are going to really do for me. But like it's a great point. But
I'm
then
more
also as
likely
you
to
know,
shoot myself in the foot.
that's what I'm saying. Like or as you know that we talked before is like I'm not sure that at this point due to like Basel III and all these other things like treasuries are collateral. Like that's what we use them for. We don't necessarily use them as an investable
That's what
asset.
I was trying to explain. Like, if you had the U.S. Treasury market blow up, like every bank would be insolvent,
Yeah.
right? All these money market funds that are being used as collateral for futures markets would all of a sudden that collateral would collapse to zero, and everyone would be getting margin called on every global asset around the world, right? It would be a disaster if you had a meaningful dislocation and re-rating downward of treasuries. Like if everyone all of a sudden lost their confidence in U.S. treasuries in a truly meaningful way.
And with that hopeful element, probably should wrap this up. Shout out to the world famous Booty Crew. Like we said, this is hopefully for entertainment purposes only. Hopefully we're not nearly as entertaining as TikTok, as Corey's pointed out, but hopefully we're mildly entertaining. And nothing that we say is investment advice. Please do your own due diligence. He's Corey Hofstein. You can find him at C Hofstein on Twitter. I'm Jason Buck, and I'm at Jason Mutiny. Corey, what else am I missing on the closing thoughts? Got the disclaimer in, got everything.
I feel like I got to tell you, these episodes, I think I'm coming off as the angry guy. I feel like I just rant a lot, and I'm really not an angry person. I think I put on this like skull and crossbones sweater, and I just get mean. I just want to say, I love everyone. You all have beautiful, great ideas. Pursue your inner truth. Have a great weekend. I don't know. Let's end it with a little happiness.
Yeah, fuck it. We're all going to die. Dress accordingly.
You can't even get the outro.
Oh, there we go.